Do you think life is simpler as time evolves? For some, it can be more complicated when facing issues about health, estate plans, probate, long-term care, and more. That's why Attorney-CPA Joe Cordell hosts ElderTalk with TuckerAllen, providing intelligent answers for those thinking about their future. Here's Attorney-CPA Joe Cordell.
Welcome to another episode of ElderTalk. We continue to be relevant to seniors as they work through a coronavirus, an epidemic, a pandemic that we thought was past us, Jill, just a few weeks ago.
Right.
And here we are. We have this renewed outbreak and then this renewed interest that's accompanying it. So that whole debate about the extent to which we are social distancing, the extent to which we're using face masks, should we be gathering? I thought we were kind of starting to emerge from that debate. And now we're just right back in the middle of it as we've had these outbreaks in Texas, Florida.
Florida really has been hit hard. 100,000 cases, I believe, or over that.
Yeah, and apparently in this case, it's largely among younger people.
Yeah.
Which, for those of you who doubt this, there are young people in Florida who are not on spring break. But in any case, Florida, Arizona, but these are areas where you do have a lot of older people.
Yes.
So I think that is really the worst aspect of this, is because when you have these higher outbreaks among younger, even if they're hospitalized, their probability of survival is pretty good. Whereas the older people, which you would expect to be the secondary effects, that's what is really the most tragic.
Yeah, that's what's, those are the group that's most at risk.
So we talk a lot on this show about health, about the things that relate to your health, but there's something else that is right up there in your set of priorities with your health. And in many ways, it's related to your health, and that's your money. So we know that you, our audience, you love to hear information that's relevant, that's interesting about your health as well as about money. So we try to interweave them from time to time. This week, we have the good fortune to have somebody on who's a certified financial planner. Many of you know I'm a big fan of this certification, and I do follow this sort of thing, and I know that it's rigorous. And so when it comes to financial planning, if you've listened to this show for any period of time, you know that all other things being equal, I suggest certified financial planners. Do you want to introduce our guest this week, Jill?
I would be honored to. John Wehmer, he's a financial advisor with Cornerstone Wealth Management. John, thank you so much for joining us today.
Thanks for having me, Joe and Jill.
Welcome. And John, when you have uncertainty like this, doesn't it make you want to err on the side of reducing the drawdown of your existing assets from month to month?
It does, and that's a lot of the conversation that I have with retirees is around that topic you mentioned. And first off, you hit the nail on the head there as far as the goal for retirement. Whenever clients come in and they're approaching retirement, boy, if they can get in a position where their entire monthly cash flow needs are met by dividends and interest and pension checks, and they're not having to sell a share of anything each month, that's the ideal position to be in. Because even as you watch the last few months, stock prices fall by 20-30% and then recover. Many companies continued to pay dividends and interest on bonds throughout that time period. So, if you didn't have to sell shares back in March, you're really not feeling that much worse, I think, than you were maybe in January or February. That's important to focus on. If you put yourself in a position through savings and through being frugal to be able to live off that dividends and interest, great. I think you're in a very, very advantageous position. If you haven't and you're withdrawing principal, I think it's wise to tighten your belt in times of economic turmoil where stocks are down in value. But I would also be advocating most of those clients probably be having a cash position. Most of my clients who are taking active distributions, I like to keep 6 to 12 months kind of held in a reserve just for times like this, just to kind of alleviate some of that stress. So I think you brought up a good point there, but it's a little bit different of an answer for me, whether a client is actually touching into that principal or able to live off the dividends and interest.
And John, since the beginning of the pandemic, we've surprisingly have seen the markets go up repeatedly. And how do you make sense of that with a high unemployment rate?
Yeah, that's the number one, I think, conversation I have with clients on a daily basis. And I really do think it's a combination of a few things. I'll mention three really brief. I think first, there's been record federal stimulus with potentially more to come, right? I mean, the CARES Act alone was $2.3 trillion, or just over about 10% of the US expected GDP. That's a big number. So I think that's part of it. Second, and I do think this one gets overlooked, and we talked about this a minute ago, but that's alternatives. And if you look at the fixed income market right now, and that's, CDs, treasury bonds, and investment grade corporate bonds. A lot of those are yielding less than the dividend yield on the S&P 500. So while I personally don't think that should be your mentality when buying stocks, I do think that has had an impact on investors, that there's just not a lot of good alternative investments to choose at this point. And then finally, I think the stock market's a forward-looking vehicle, and it's not meant to move in lockstep with every economic indicator that we have. When there is optimism about the future, whether that be 2021 earnings, more federal stimulus, or a potential vaccine, that impacts prices. And while there is reason to be optimistic about those things, I think there's also a lot of uncertainty about those three things. And the market is constantly balancing those outcomes. I agree, though, it seems as of late that optimism has been the stronger of those two forces.
So let's talk a little bit about real estate and houses. Many people, as they age, they want to downsize, move into something smaller. Some had plans before we went into this period over the last 4 months and have since put those on hold. What is your advice to your clients regarding their housing costs and their housing options during this period of time? Have those conversations come up?
Not too much. I mean, to be perfectly honest, I don't think we've had too many of those conversations. I've always tried to do, try to talk about my clients when they frame retirement goals into a needs and a wants number, right? And my goal is for my clients' needs, those things like shelter, food, the things we have to have. I want those, that cash flow or that income, if at all possible, I want that to come from non-equity sources, right? So that even in times of economic turmoil or recession, that we're not having to make those decisions. But I hate to have those discussions, as a move because, the stock market's down. So, first off, I'd say if you're in that position, then it really comes back to looking at, what's important to you and what your trade-offs are. And, if it's something where you have to downsize, then I think in this environment, the real estate market is kind of similar to the stock market. Usually, if you're selling your property and let's say home values are down for whatever reason, usually you're going to turn around and buy something else that's at a maybe similar discount. So you kind of insulate yourself from wild price movements. Now, if you're moving out of a home you own into a assisted living facility or something where you're not going to own it and you're going to be paying rent, that's a really tough decision to make in this environment. And that's one that I really advocate people sit down with, whoever their financial professional is and look at the long-term implications of that.
Well, let's do this. Let's take a quick break, and we'll be back in just a moment with ElderTalk.
You're listening to ElderTalk with TuckerAllen, providing intelligent answers for those thinking about their future. Sponsored by TuckerAllen, your estate and elder law advisors. And now, Attorney-CPA Joe Cordell.
Welcome. We're back with ElderTalk, and with us today is John Wehmer. He's a CFP, Certified Financial Planner, for those of you who don't know these things, which you should. He's a financial advisor with Cornerstone Wealth Management. So, John, you work with a lot of seniors as well as younger people, but we're interested particularly in what advice you have and comments you have relating to financial planning and financial issues for seniors. I know a question that's floating in the minds of many listeners, including those of us sitting here today who are thinking, what can we expect for the balance of this year? I know you don't have a crystal ball, but give me your sense of what you think is going to happen over the balance of this year and whether we're going to be into a recovery next year.
Yeah, I'm actually fairly optimistic, but I'd also say I balance that with some with trying to be realistic, right? So I think we will see earnings continue to bounce back for companies who were quick to adopt technology this year. And we talked about a few sectors earlier, in retail and travel that, those sectors that deal in crowds, I think will continue to struggle as we continue to learn more about this virus. So because of that, I don't really see unemployment getting to the, pre-pandemic levels anytime soon. But, that doesn't mean that equity and stock performance, still can't do pretty well in that environment. Our research department here had a target of about 3,100 on the S&P 500 by the end of the year. We're kind of flirting at those levels right now. So, what I'm telling my clients is let's be realistic and let's look at since January 1st of 2019. Let's go back and take those 2-year return numbers. And, if I talk to my clients about what all has transpired with the economy since January 1st of 2019, most of them are pretty happy with where they're sitting, given the hand we've been dealt. So I think we'll continue to see some struggles with things like the unemployment number and some of these big, broad economic indicators. But I'm very optimistic about the long-term future of these companies.
Yeah, and I tend to be cynical about the propensity for people who are commentators online, of which there are far too many, but they tend to be quick to say, life will be changed forever. Now, you don't hear it quite as often now as you did 3 months ago when you heard it daily.
Doom and gloom.
Sure. Yeah, that we'll never go on cruise ships again. I heard that statement made in sometime in late March. The industry's dead. Now, human beings have been cruising for, I think I can safely say, a couple of thousand years.
Right.
And I do not believe that all the people and all the fun they have on those Carnival cruises, I don't believe that they're going to suddenly conclude they never want to step on a cruise again. I mean, Americans have found that it's a cheap way to travel. You get a lot of, you get the opportunity to have food pretty inexpensively and
delicious food at that.
Yeah, and your kids can run around freely. It's a pretty safe environment for your kids to not be watched closely because they are contained. And so there's lots of reasons people like cruises. You don't carry your luggage from port to port. Instead, you get on one ship one time with your luggage and you keep it there and you go to different places. So I always felt that, and I still feel that whatever Carnival goes through, and was Princess Cruise Line, I think is one of the Carnival lines, but there are, what is the other, or 2 or 3 major lines that have been.
Caribbean.
Royal Caribbean, yeah.
Yes.
So I know they've been punished brutally, but do you agree with me that you think that as long as these industries can stay afloat, no pun intended, for the next 6 to 8 months, that they're going to pull out of this? Do you agree with that?
I'm not an expert on cruises. Let me say that first off, because I think that people will. I agree with your assessment that people aren't going to give up cruising altogether for the rest of humankind, right? I think that people tend to have some recency bias, right? So it's easy to say that now, but in 5-6 years from now, I certainly imagine people will be back to cruising at a pretty high rate. I don't know that it'll ever surpass the record numbers that we saw in the prior 3 or 4 years. But I think from an investment standpoint, not just looking at that industry as a whole, but like talking about the value of the stocks and investments in that area, I'm not a big proponent of taking those type of risks, in the sense that obviously with cruise lines and cruise companies, there's an extreme risk versus reward scenario. So I kind of, when you start talking about investments in those sectors, I really do look at that as more speculation. I think it's okay for investors to do that in very small doses. The majority of the money that I'm managing for my clients is more, I think, conservative long-term money. So we don't do a lot of that speculation on a day-to-day basis, but it is very interesting to follow. I certainly agree with you on that.
And so the similar statement would have been made about travel, about airlines. People are never going to use airlines the same again. And I don't know of any of those statements that are so conclusive and sweeping and forever that I would agree with, and including the fact that airlines, are going to permanently suffer. I know they're going to suffer for a while, and of course they are. So are there? Go ahead.
I think you can draw a clear line between those two, but and again, it's that want versus needs line, right? There's not a lot of people that have to cruise that need to cruise. That's more of a want. So I think we will see a longer recovery, in demand for cruises than I think we'll see with airlines, because airlines, some people fly, and I don't know what percentage of the sector flights are for personal or pleasure versus business. But there's still a huge swath of our economy that requires flying to major cities day in and day out. So I agree with you that it's just, I can't fathom a scenario where flight just halts. And that's an industry where I think demand will come back a lot faster than the cruise industry.
Hotels, entertainment industry. I can tell that you're in this camp where you're a little sympathetic to this argument. So would you also say that entertainment industry is going to be affected for the long run, maybe permanently?
Yeah, that's a tough one too. I hesitate to say permanently, and you mentioned the fallacies of that, right?
Yeah, there are a few, but go ahead.
But yeah, the problem with that is I'm looking more the next 18 to 24 months, like how fast will we see demand come back?
Yeah.
Because and I see a prolonged delay in things like cruises and things like major sporting events. But on the flip side of that, if we're talking about the health of the overall economy, what we may lose in people, attending 60,000 person events at a big stadium, we may have to go without that type of an event for some period of time. And if that happens, though, I think it will be made up in equal force on the other side of the equation, where you've got, sports gambling and some things that are really progressing on that front. So I think a lot of these areas of the economy where we're going to be kind of sucking revenue out that may take a long time to come back, I think that revenue is going to kind of get divided up to some other, areas of the economy. So, even though I might not be as optimistic as some of my peers about these individual travel and entertainment sectors, I don't think that they're going to lead to the death of the U.S. economy. I mean, if you start talking about 2021 and 2022, I'm very, very optimistic about that place, because I think, we've finally gotten to a place with this virus where, businesses, government, community leaders all seem to be pushing in the same direction towards a vaccine and enhanced treatments. And I think as a people, we're still a pretty resilient bunch, right? I mean, we've taken in the U.S. past economic challenges and turned them into, really defining opportunities that set us apart from the rest of the world. And I don't really see this time being any different. So I'm looking at specifically, looking next year to 2021. I really see that as a year of investment. I think we're going to see companies investing more and more in technology and new innovative ideas. I think we're primed to see the government potentially invest in the infrastructure of our nation. If unemployment stays, really high, I think that's a tool that they'll be willing to pull out. And then I think that we're primed to see communities reinvest in people, like retrain some of these retail workers that maybe aren't going to go back to their same exact job. But we've got a big demand coming up as people accelerate the use in technology. So I don't really have a firm, 2021, S&P target yet. But historically, investors have rewarded those types of investments in the long-term health of the U.S. economy. And I wouldn't bet that this time is going to be any different.
John, are you optimistic there will be a vaccine before the end of the year?
No, I'm not. I'm great. Great. I shouldn't say that I'm not optimistic about that. I pray and wish for that on a regular basis. But, I'm operating in taking past historical vaccines, looking at the time. And, I find it hard to believe that we'll have one by the end of the year. I would love to be wrong, right?
Yeah, everybody, we understand that.
Yeah, but I'm trying to be realistic, and I think even with some of the accelerated, they're building out facilities and got manufacturing, it sounds like ready to go as soon as there's something approved. All that is I think the right direction, but I think realistically, late, mid to late next year would be, I think, a pretty plausible, feat at that point, right? I think it'd be something to really be proud of, to have a vaccine that fast. If we go one before the end of the year, I would be ecstatic about that.
But even if we do have one by the end of the year, do you think it's really going to make a difference? in the
Well,
economy?
it'll make a difference in the long term, but yeah, I have my concerns. You're going to have a swath of the U.S. population that probably won't take the vaccine, I would think, right?
That's what I
Especially
mean.
if there's a narrative that it was rushed to production. So, I'm not a scientist in the sense, like I don't know the exact ramifications of if we had a vaccine and only 70% of the people were willing to take it. And then also, I'm pretty realistic that when we talk about globally. And this is one reason I'm maybe not as optimistic about cruise ships, but if we get a vaccine in here in the U.S., it's widely available. The cold reality is it's probably not going to be available to every corner of the globe for some time. And when you start talking about cruise ships and getting people from all over different countries, all commingling on one place, that's why I think that may take a little bit longer than maybe domestic flights demand to come back. So again, I want to be really clear, like I'm not an expert on any of this vaccine stuff. It's just, I'm trying to look at all the data and be as realistic as possible with also taking into account that, Americans have been extremely innovative in the past, and I hesitate to bet against them in the long run on any front.
Yeah, and I think that's the bottom line, and it may be a therapy that is more likely for the balance of the year, but I think that probably we're going to spill over into 21 before we see a lot of any persuasive argument of a quick return. But one positive development, I guess, for many people this year is that they find that their costs of living have gone down, that perhaps they've not traveled this year, places they thought they would have, places they would have gone in terms of entertainment. We talked about travel and entertainment industry. They're representative of the fact that it has declined dramatically. So I guess that means people's living costs for this year will be significantly less, and the demand on their portfolio correspondingly less for this year. Is that true for many of your clients?
Yeah, you bring up another good point, Joe. I think a lot of my clients have seen their spending as a whole go down in a meaningful way. A lot of that, unfortunately, is because of travel, right? Most of my retirees make pretty extensive travel plans. On a lot of those, we just couldn't do this year. I've been really interested to find that the amount of clients that I've had, both working and retired, who are diverting those funds into home renovations, though. And it makes a lot of logical sense, too. But I love asking my clients those questions as far as what do you spending your money on these days, or any of your discretionary money, because that tends to give me a good head start as to where I'm looking for areas of growth in the economy. And when you look at the amount of people that are doing home renovations, I was down at the Lake Ozarks over the last weekend at a friend of mine's place, and we just took the family down there. And the amount of construction going on in that lake is hard to fathom.
During this period.
Exactly. I think people are just camping out down at their lake homes, and
they feel safer,
I think this
probably.
I think this brings up a good point that there is this pandemic has hit different areas of the economy much, much differently. I mean, we're approaching July 1st right now, which is we're expected to see a record number of eviction filings on the lowest kind of segment of our income ladder. But meanwhile, we have a big swath of our, more white collar workers that are not seeing much of a difference in income. So I think this thing hasn't been impacting everyone equally at this point. I've been looking to areas of the economy where my clients are shifting their resources, and if they're not spending, an extra $5,000 or $6,000 on maybe a travel item, and that money's going into redoing their deck, I'm certainly looking at companies that are going to be benefactors of that.
Yeah, and I've noticed that too. What you've described, how there is a difference between how this is impacting different types of workers. The people who work from home are people who, for the most part, are office workers, meaning they're cognitive workers. They're typically white collar, but in any case, they're office workers. Whereas the rest of the people who have to show up for blue collar jobs, working from home is not an option.
Right.
And so these people have to show up every day. So the way they've experienced this pandemic has been different from those who've been in their houses drawing their full paycheck, most,
Exactly.
And I know that, Cordell & Cordell has lawyers distributed across the country and in the UK, and there haven't been layoffs from Cordell & Cordell, and so these lawyers continue to be at home. They can generally work from home, and many have been, but not all have been fully engaged in that way, as you might imagine, because the legal industry is affected like pretty much every other industry, and yet they're continuing to draw their paycheck. So I think that's a bit of the tension that exists between those who can very comfortably say, look, let's just be safe. Let's continue to social distance. Let's continue to stay home. Let's not go out any more than we have to. And they're finding that the consequences to them of these policies are not very rigorous or very painful, whereas those who are, because of these policies, actually unemployed, presumably not getting checks, and for whom the hardship's much greater by these sorts of policies, then they tend to oppose them. So there is, I think, for lack of a better phrase, there is almost some class tension between that first world and the second.
I don't think I could say that any better than you just did. I mean, a lot of the focus seems to go to class divides among politic lines or other racial lines, but I think a lot of it has to do with this economic, difference that we have in this country. And, there's certain periods of time where it rears its head more than others. And I think right now we're in one of those periods of times where it's really been brought to the forefront. So again, I get optimistic about that, though, because, I happen to think that we'll see a surge in the voice of those workers that are essential. And maybe some of those industries should be, paying more. I think, this is one of those times where we're going to get to reevaluate and kind of reset what the next few years looks like. And in the past, when the U.S. has had those opportunities, they've taken advantage of them to the point where it's launched us and gave us a competitive advantage against most of the rest of the world. So I'm still very optimistic on that front.
I want to ask you another question, and you can actually answer this without being political at all. So continuing to wear your certified financial advisor hat, so when you think about the implications for the election that's going to occur in early November, what do you think from a financial standpoint hinges upon the victory of one or the other? I assume we're going to have Biden on the Democrat side, all indications. No one's arising to compete with him. So we think that's a foregone conclusion. Trump, of course, we know is going to be the Republican nominee. So tell me what you think the world looks like depending on if one versus the other goes in. From a financial standpoint.
Yeah, that's a tough question. So I think first, let me say this. I've done a bunch of research prior to the beginning of this year. The number one item on people's minds for 2020 was this thing we have scheduled in November called an election. So we were doing a lot of studies on that. And, your typical election year, presidential election year, the market has averaged around 10% returns. In a non-election year, the market's averaged around 10%. So I don't know that we need to make any other, changes in anticipation of some big deviation from the norms because there's an election. Now, when you start talking about which direction, I think the country's going to go, I think both candidates are going to be trying to appeal to that demographic that you just mentioned, that essential worker that has to kind of go out and clock in every day. And, when we talk about long-term policies, I think we really have to look at the Democrats right now and a Biden presidency, I think would be asking corporations to maybe pay a higher share of,
you think that's possible?
The tax revenue. And I think with that, he's going to, they're going to have to provide something for that, right? And to me, that would be something along the lines of we're going to require corporations to pay higher taxes, but we're going to use that tax revenue to outfit community colleges to help retrain this workforce so that you've got a better pool of potential candidates in the future. Now, that's a tough sell for corporations and for the American public, but I think that's going to be kind of that sell of investment, right? We're going to ask you to pay more, and then we're going to invest that in the economy.
But I don't think it's being too political. And I know that I wouldn't expect you to be too uncensored in this answer, because I understand your job is not politics, and nor do you want to alienate loyal political proponents on either side. But I do think, though, that some things, surely you would agree. I mean, we know that if Biden wins, there's going to be higher taxes. Agreed?
Agreed.
Okay, we know.
I think that's. We don't know that. I think that's a safe assumption.
Okay, we'll settle for a safe assumption. And we also would expect more regulation, right? We'll return much of the regulation we had. So
sure.
So those things, I think, and I think the business climate will not see the level of accommodation that it has seen in the past. And I think that's because of kind of what's being promised in the constituency of one party versus another. So I do think that, and I don't think you'll disagree with me, that this presidential election presents two very, very different paths. And I think the last one did too. I don't think the one before that one did. I think was it Romney and Obama. So I mean, and McCain and Obama. I don't think those represented dramatic differences one from the other. I mean, those candidates are pretty similar. But I think the last one, Clinton, to be honest with you, is probably less different from Trump than Biden will have to be. I mean, then he'll have to be. I think Biden, by his nature, isn't particularly leftist, but I think in terms of what he'll have to be. So in this case, I do think it is a broader divergence of paths between our two candidates this year versus even than last year.
I agree.
Do you agree with that?
I agree. I do. I think there's going to be, the pitch, from an economic standpoint to the American people, I think from a Republican standpoint, it's going to be more what we can do right now, right? I mean, what can we do to pump some energy and some steroids into the economy to have a fast recovery now. And I think, the pitch from the Democrats are going to be more of a long-term investment in the form of higher corporate taxes. Now, I don't know which candidate's going to do a better job of making that case, and I don't know how the American public's going to fall on that spectrum. But I do agree with you that it's quite a different path. I also think, a lot more retirees that I've talked to, or at least those clients that are approaching retirement, I've been hearing a lot more questions about entitlement programs like Social Security and, Medicare in particular, and how those impact our retirees. And we're starting to see, I think, interesting focus there, where as we're racking up national debt, we're going to be having to have a pretty serious conversation in the next 5 to 6 years on how can we shore up our entitlement programs. So I really hope that gets talked a lot more about between now and November, because I think that's a serious issue that we need to kind of look at a little bit closer within this next presidential cycle.
And I think another comment, though, that I think you'll agree with, and I want your thoughts on, is that both parties have made a commitment to more spending and have been very comfortable with supporting the spending we've had so far, which there's no precedent. If you include what the Fed's doing as well as fiscal spending, there's no precedent for this in human history that we know of. Maybe Wehmer, Germany, after World War I. But the point is, you would think that this would produce inflation. You'd think this is very simple math, that you take a certain quantity of money supply, and then you increase it 10, 15, 20% perhaps or more. You would think that's conclusive evidence that we're going to have inflation, but it turns out that it's more complicated than that. But I'm not, at least if we ask economists, it's more complicated than that. So I expect inflation, and that's kind of driving some of the things I personally do in terms of investment. I want to know your thoughts. Let's assume in this case it doesn't matter who wins the election in November. I think clearly there's not the political will on either side of the aisle to shut down this sort of fiscal and Fed spending as necessary to keep the wheels churning and keep consumer spending. So do you see inflation as an engine to consider, or a factor to consider in investments, say in 2021 and beyond?
I always think of inflation as an enemy. And really, when you're talking about planning for retirement and something as serious as working out your cash flows for potentially 20, 30 years, I could argue that inflation is most investors' number one enemy, right? Now we haven't seen it as a very strong enemy in the last decade.
Yeah.
But and you're right. If what happened in 2008 with all the quantitative easing and all the money pumped into the U.S. economy, if that happened in an economics classroom, we'd see inflation fly off the charts. But I think what happened was we just didn't see that money actually circulate in the economy. We saw a lot of banks and other financial institutions hold on to that. Now, this time may be different. I could argue we are seeing that money circulate the economy. We printed out checks and mailed them to people's houses.
Yeah, that's pretty effective.
I would argue that is actively circulating, and that should lead to inflation. Which brings me kind of back. Earlier in the conversation, we had brought up the lack of alternatives, right? Like if you're going to go buy a CD right now, I don't know what rates are. Let's call them 1% would be the average CD rate. Is that going to keep pace with inflation the next 5 to 10 years? I would think not. Historically, it has not. So I think a lot of the reason you've seen the stock market perform well is investors are very cognizant of inflation. They're concerned about it. And they understand that the best way to combat it in some cases is going to be to own the companies that have the pricing power on those products. So when they have to pay more for their phone bill, they can maybe match that with some ownership in AT&T stock. Or if they're gonna, have a higher Ameren bill, they can match that with owning some equity there.
And for example, another industry that might benefit would be real estate, would you say?
It depends on what type of real estate you're going to be looking at. But I would say residential real estate, I'm in the camp too. And I know it sounds like we may be differing on this a little bit, but you start talking about commercial retail, and I have to imagine there's quite a few small, medium-sized companies that have by necessity invested in technology and have probably realized that they could go without 10 locations, right? Maybe they only need 6 or 5.
I think that's a real trend.
So I hesitate to get real excited about real estate. Real estate's never been a terrible investment to own. But when you start talking about the risk right now with our economy, I think one of those is that you're going to see a contraction in commercial real estate.
I think you're right.
And that's not an area that I really focus on anyway. It's usually a small sliver of an overall portfolio here. So again, I'm not an expert on real estate, but I think logically you could come to that conclusion pretty easily.
Yeah, no, I think that makes sense. I think commercial space is something that people are going to find that companies will find they don't need as much of, including, we're having meetings and we're finding that all this office space that we thought we needed in all these cities, we're suddenly thinking, boy, we could go down 500, 600,000 square feet. And you do the math on what that saves you, adjustments like that. And it's huge. Yeah, over 70, 80, 90 offices. So many people are doing that math right now.
Exactly. And you look at that in a lot of industries, right? And industries that maybe 5 or 6 years ago, it wasn't even fathomable. You couldn't even really think of a scenario where you wouldn't have to have a physical location in every, city that you did business in. But, here we are now a few years later, and it seems pretty practical. I was talking to a colleague of mine, a peer, who, we were kind of all complaining about the adjustments that we've had to make to deal with this pandemic. And he told me, he goes, listen, I'm excited because he's from a foreign country, and he's excited about maybe being able to go work a month or two from home in future years. Whereas before he, never thought that was a possibility. But now, working remotely for a month or two is not only, feasible, he's had practice in it, right? So I think there's a lot of silver linings with that. So me personally, I've been trying to balance that with being empathetic to those who don't have those luxuries, right? Who have to kind of go in every day. And we talked about the fact that we've kind of got two parallel economies in that stance.
And, I do think that it has been effective for a lot of industries to have their employees working from home. And I really think that will continue beyond this pandemic. I think we're going to see a new trend.
Yeah.
Yeah. And what does that mean for places like San Francisco and the Bay Area? They're suddenly people are finding out that they don't have to live there and pay those costs. And you hear of places like Austin being the beneficiary of that. And other much smaller cities around the West and Midwest, where people who formerly had to live in these tech centers, Silicon Valley, suddenly finding out they don't have to. So I do think you're right. I think it will change the landscape. And remember, as the CEO of Airbnb said this morning on CNBC, he was being interviewed, and he said, look, working from home means working from anywhere. And so he's commenting that they've seen this surge in guests coming to Airbnb properties, many of whom are not on vacation. They're working, but they're working from home, and they're finding out that working from home means that they could go to a wonderful place, and as long as they're doing their work, they can be there and get it done. So I do think that it could mean opportunities for segments of the economy that we wouldn't normally identify as being beneficiaries. So it's a strange world we live in now.
And I'll ask you guys, if you compare the U.S., and I'd be interested to get your opinion on this. If you compare how the U.S. is set up for that, right? Set up to work remotely, how almost everyone has, an internet connection and the ability to do that, depending on the industry, but, a lot of people do. Compare that and contrast that to some other places around the world that we're competing with. And I do think that that's one area where we could arguably have a competitive advantage already, and that competitive advantage could continue to widen if we take advantage of that opportunity. So again, I am optimistic as a whole about the U.S. economy the next 3 to 5 years. I know you said that's kind of the timeline a lot of your investors are looking for, but I do think that you don't have to make bold predictions and be right with the airline or cruise or real estate industries. I think to kind of, if there was ever a time to practice good diversification, this is it, because I think you could make a strong case, positive or negative, for a lot of areas of the economy. And as boring as it is, diversification has shown to yield exponential results compared to owning a concentration in one sector versus another. Yeah,
I think you're right. And when we look at that opportunity for technological infrastructure, I think that we need to proceed as boldly and as aggressively as we can be regarding this 5G. I mean, 5G is going to be a hugely important factor in allowing us to work from home and do things remotely than we otherwise would. And so I don't know if this dispute with Huawei, which has they've dominated the sector, and it means finding alternatives to them, and we are pursuing those. Some with the company in Taiwan that I hadn't heard of, but they're undertaking to replace Huawei and many of the infrastructures in Europe and the U.S. if they can win those contracts. But so much to talk about in so little time, John.
Yeah, absolutely. I did enjoy our time today, though. I do appreciate you and Jill inviting me to have a conversation with you and your listeners.
Yes, and it's very informative, and we're going to have to circle back and see how well your crystal ball has been working.
Well, I'll tell you what. Anytime you guys would like to have me on, just to reach out, and I'll be happy to join you.
No, it's been very informative, and yes, we definitely do want to circle back. Again, we've had John Wehmer, CFP, financial advisor for Cornerstone Wealth Management. Till next time, John, talk to you later. And this has been another episode of ElderTalk. Take care.
You've been listening to ElderTalk with TuckerAllen, providing intelligent answers for those thinking about their future, with Attorney-CPA Joe Cordell. Sponsored by TuckerAllen, your estate and elder law advisors. For more information, visit TuckerAllen.com. Listen again next Saturday for another edition of ElderTalk with TuckerAllen. The choice of a lawyer is an important decision and should not be based solely on advertisements.